Verizon shares rose quite sharply after reporting better than expected Q4 results, driven by strong broadband growth and consumer retail post-phone net adds. The subscriber momentum in these two segments allowed Verizon to achieve higher than expected free cash flow for the fiscal year of 2023. And as you can see, year to date, they are up 12%, and over the last year, they are also up roughly 5%. So have actually delivered quite strongly compared to some of the recent times for Verizon has gone down over a 5-year period of 25%. And actually, if we just look at January, Verizon was actually upgraded as key bank upgrade side strength compared to the AT&T. So they were upgraded by the capital markets on Wednesday back in the start of January, and the investment firm cited the low competitive environment in the wireless industry and its broadband strength compared to AT&T. Then, just a day later or 2 days later, Verizon got a second upgrade, this time as Wolf Research boosts its rating. Again, also, as mentioned, received the second upgrade in a week as Wolf Research upgraded the telecom giant based on the fact that exiting one of the toughest positions strategically over the past 2 years. So investment moved its rating on the Hans Webber Select company to outperform from peer perform and put a $46 price target. Notice upside and improved subscriber growth, and as we saw from the earnings report just here, they actually delivered on that promise. So as you can see, Verizon net non-GAAP EPS of $1.08, inline revenue of $35.1 billion, beats by $550 million. So obviously when you get 2 upgrades and you perform on what you set out to do on your strategy, then obviously the market will return the favor and indeed get you going upwards. So as you can see here again, up trading around $42 right now. If you zoom in just to the last 5 days, you can see report out here and then it boosts quite a bit. It fell down a little bit, but now up back up just over the $42 mark. And if you take a look at the dividend, let's go down here to see dividend yield of 6.29, annual payout of $2.66. Payout ratio sits firmly below the 60% mark of 60%, sorry, around 56. 2-year growth rate, a 5-year growth rate of 2%. I will assume this will continue in the future. As you can see here, dividend growth streak of 19 years as well. And if we zoom in a little bit on the dividend history here, take the dividend history and then zoom in for the maximum. You can see here they have indeed delivered shareholder return by consistently boosting their dividend, but again, not by that much. You can see the 23 years consecutive years of dividend payment, 19 years of dividend growth. So they are delivering back on their promise and are raising dividend, but ever so slightly. And if you jump into the financial statements, you can see here that indeed we are looking for some revenue growth. So over the last 5 years, back starting December 2023, back to 19, you can see here 133 billion up from 131 billion. Not a huge amount of growth, but again, they have been in a tough position. So I think it's pretty good to see they've actually been able to grow at all the revenue, even though it's just a slight. I think for a company like Verizon, just steady, slow rising is kind of what you expect to see and what you want to see. If you suddenly see a massive improvement, then I think it'll be very hard to follow up on that, obviously. And coming down as well to the net income, obviously also want to see that increase, but it has actually gone down a little bit from 19 billion back in 2019 to 11 billion in the report that just came out basically. So it will be exciting to see whether or not they can increase this net income in the in the future. I can think they have a lot of exciting opportunities to actually do that with 5G and everything rolled out at the current time. So let's jump into the balance sheet as well to find the cash and cash equivalents. You can see they have roughly $2 billion cash on hand. And it's been pretty steady for the last couple of years. They've been up 2.5, then a massive amount of money back to 3, 2.6, now down to 2. So again, pretty steadily. And obviously something that is the big fish or elephant in a room for a company like Verizon is obviously the debt. So if we come down here to the long-term debt, you can see $137 billion in debt, actually gone up from 100 billion back a couple of years ago, but they have reduced it a little bit from 143 down to 137 right now. So this is a major red flag by of Verizon, I think. I actually tried to look in the investor report for Q4. You can see here consolidated cash flow. Normally if you have a very good debt structure and you have a long-term to maturity, you want to highlight that to not scare off investors. But in this case, they have not really explained that much. They just explained that the cash flow from operations will have gone up from 2022 to 2023, which is good to see. Capital expenditures have gone down considerably, almost 4.5 billion, which is really nice. The free cash flow up to 18.7 from $14.1 billion. So again, also extremely nice. Dividend paid Gone a little bit up again, so that is expected. This down here, the total debt, unsecured debt around 128, and the net unsecured debt 126 compared when you withdraw the cash and cash equivalents we saw earlier, roughly 2 billion. So the net unsecured debt to adjusted EBITDA is 2.6, down from 2.7. So I think this is really what they want to highlight. And as you can see here down in the bottom, strong cash flow enables flexibility to deliver on capital allocation priorities. And that's actually a really good line here, because capital allocation for them is obviously to not to be able to pay the debt and still be able to pay the dividend. So it looks pretty good. You can see here $18.7 billion free cash flow, $11 billion in dividends paid, and then you still have 7 point something to pay back debt if you just want to meet your obligations, or even pay it further ahead, or maybe even buy back some stocks if you believe that the stock is undervalued. Could initiate a stock share buyback program. Obviously, that is one way to do capital allocation. So I think right now it looks pretty okay. Later we'll jump into SimpliSafe Dividends to actually take a look at what their score for Verizon is. But before we do that, let's just quickly jump into the cash flow statements as well. You can see a cash from operations. It's pretty firmly. There was one blip year here about 41, but otherwise 35, 39, 37, 37. And as we just saw before here, the capital, the free cash will be again 37.5, and probably will be roughly the same. But the capital expenditures have gone down. That is really nice, because you can see here 17, or let's call this 18, 18, 20, 23, 18, and then back again quickly here to in the future. Not in the future, but capital expenditures down from 23 to 18. So I believe this will probably be a very good highlight going forward. I think they can, if they can continue to reduce their capital expenditures, freeing more free cash flow basically from their operating income, that would be extremely nice. Also to make sure the dividend is safe and also be able to meet the demands on when they need to pay back the debt, and maybe initiate some more shares to be bought back if they feel they are undervalued at the current level, of course. And one last thing in the cash flow statement, let's come down here to the bottom to see the free cash flow per share, and sits around $3.07. And if you remember earlier, the dividend was $2.66 per share, so plenty of room to cover the dividend indeed. Looking pretty good. One last thing before we jump away, sorry, I do want to check how much common stock is, how much total shares out of filing date. As you can see here, they have not been able to buy anything back. Actually, they sit around 4.2, so roughly unchanged basically. But let's jump quickly into the peers of Verizon before we jump into SimpliSafe Dividends. You can see Verizon Communications and has gone up over the last year, almost, let's say 5, but compare that to AT&T, down 15%. So if you have been able to choose Verizon over AT&T, you would be pretty okay. Obviously, it is an income stock. It's not something you would expect to explode in capital appreciation, but still, it's nice to have that as a bonus, I believe. But let's jump into SimpliSafe Dividends to take a closer look at some of the data behind Verizon. As you can see here, the dividend yield 6.3%, as we mentioned earlier. Dividend safety sits around 70, which is their safe rating, which is pretty good actually. I would have expected it actually to be a little bit lower, but I think it's still pretty good. So dividend growth in the slow category, we are aware of that. We have discussed that. If you come down here, you can see actually the dividend was rated as very safe, and then was downgraded first to safe 80 score, and then now down to 70. And you can see here, let cable allegations as to Verizon challenges. And this is a bit of downgrade. You can see it's back from July 2023. So I think this is still very, very fair. I think maybe next time they could probably upgrade it back again to 80 or 75 or something, based on these free cash flow that we saw earlier in the investor presentation. As we saw earlier, you can see the payout ratio sits around this 56, which is low for telecom, so that is looking pretty good. 58 projected forward, also again low. Net debt to EBITDA is a bit higher, and it is indeed high. The debt is one of the big red flags for Verizon. I think this down here is what you also want to take a look at. The recession dividend was actually, the dividend was increased during the last recession, 2007, 2009. Recession sales only dropped 1.2%, which was above the average during that same time period. And the recession term was just minus 38, sorry, instead of the minus 55 if you just held SP 500, again on the same time period. The dividend growth is nothing really to be hype about. It's 1.9% last time, 2% over the last 5 years, as we have discussed already, and over the last 3 years is mere 3%. So this is indeed what you would be expecting in the future. I would be expecting these 2%, counting on this, just beating the regular inflation, basically, almost instead of anything big, obviously. And the dividend growth streak of 16 years and uninterrupted dividend streak of 39 years are also something you need to take a look into, obviously, and take into account. It's nice to see here the payment details. So if you were a holder, you will be looking at a payout on the February 1st, and you still have a couple of payments out or payouts before they consider raising the dividend again. With regards to timeliness, the dividend yield sits above the 5-year average and is lower than the usual forward PE ratio, so it could potentially be undervalued, at least according to the dividend yield theory we have on the left, basically, and the mean reversion theory, which is the one on the forward PE ratio. You could call them that. So the sector PE, Verizon sits around 9, communications roughly at 17. But again, there's also companies like Google in communications. So this one, I don't think you can really use that. You have to compare it to other telecommunications company and not just communications in general. But as you can see here, over the last year, it actually sits right at the top. So again, taking a look at some of the metrics we have here, you can see the earnings payout sits around 56, 58 next year. Below 70 is their preference. I think below 60 is better, but that's a bit more conservative on my side, basically. And again, also for the free cash flow, sits pretty nicely, and they expect to be able to gain more free cash flow next year, so it's actually even better around that 60 mark, which is looking pretty good. With regards to earnings per share, you obviously want to see them steadily increase the earnings over time. I think for Verizon, it's gone a little bit up and down. Basically, they haven't been able to grow it that much. We also saw it with the shares outstanding. One way to actually increase the earnings per share is also by reducing the number of shares outstanding, and they haven't done that. I think with their debt obligations, I think it would be very wise to just keep chipping away at that debt and then try to maintain the dividend. I think that would be the strategically most wise strategy for Verizon, as well with the free cash flow per share. Again, also stable, growing free cash flow over time, which is something they can fuel sustainable and rising dividend with. I think right now they are maybe on track to see. You can see it starts to get a little trend from the last couple of years and going forward. So hopefully this will keep going into the future. Again, as we saw earlier, shares outstanding, I won't touch on that one, but total sales, so again, healthy business will grow them. So 127 billions up to 135 back from the last 10 years. So they are slowly growing, and I think it's nice to see it this way. I prefer steady and moderately raising sales instead of just big outliers and very volatile sales. So I think this is pretty good. Also, return on equity, return on invested capital, both are looking pretty good. You can see it sits around that mark on 11, which is their preference. On SimSafe dividends, it's at 13%, pretty good. I think the return on invested capital is really good as well. It's pretty interesting to see why it's gone down from 18. So it's actually decreased every year by 1% or 2% now to 9. So I think still it's okay. I think it's pretty good they have these steady, be able to deliver steadily above the 9%. But again, I think here on return on equity, I think this is looking pretty good actually. The margins also, operating margin, free cash flow margin also looking really good. They have really strong, steady margins. Operating margin sits around these 20 something percent, which is way above the 14% preference for telecoms that SimSafe Dividends has. And again, also free cash flow margin above 7%. They also look, there's one blip year back in 21, but again, they are pretty consistent over that one. And I think these three graphs pretty much highlight the red flag for Verizon about the debt that we have been talking about a lot of times. So you can see net debt to EBITDA below 3.5, looking pretty good, 3.2. So that is okay. Net debt to capital, I think most of their capital actually comes from debt, which is obviously not that good. But again, they have a huge debt, so it is what it is. But you can see they have gone down from 0.91% roughly 10 years ago down to roughly 2/3. So that is looking really good as well. The interest coverage is pretty good. They actually have a lot of cash to be able to pay the interest, so it's not as bleak as I like to paint it, but it is a massive red flag. The debt is there, and it would be fun to see more about the maturity about it, because as you saw earlier from the investor presentation, they really didn't highlight anything about that. Before we jump into the stock valuation, as you can see here from the ratings, you have Wall Street analysts. They have it actually rated as a strong buy or a buy at least. You can see 8 on the buy side, strong buy, 8 on the buy side, 10 on hold, only 1 on strong sell actually. So if you come down here to the price target, you can still see the average price target sits around 45. So still a little bit upside from the current levels. Not a lot, but we are around that level. So could still be a good enough time to get in if you are interested in the company. But let's jump a little bit into the stock. Stock screener, as we have seen a lot of times. So a lot of these things we have already gone through, so I won't spend a lot of time going around here. I think most fits pretty much what we have seen earlier. Also, this one that we have usually gone into, we actually have the same dividend yield theory graph down here. And as we saw earlier, the growth is very, very steady, around 2%, low but steady. So we also have a lot of different valuation methods. So I won't go into the details about all of them. You can stop the video at any time if you want to take a look at some of my estimations here from the different models, such as free cash flow valuation and so on. And lastly, the Peter Lynch model. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary where we do have all our valuation methods for Verizon. And as you can see here, we do have a lot of them. I don't want to exclude any of them. So the average intrinsic sums up to around $44. Let's remove this margin of safety. And as you can see here, we do have a current price of $41. So a bit below the average intrinsic value, actually, a bit below the analyst target price as well of around these $44 to $45. We do want to apply a margin of safety, obviously. So we do use our margin of safety calculator over here on the right. I think for the payout ratio, this isn't true because as we saw earlier, there's actually plenty of more places where I think this number that gets put in here is probably wrong a little bit. So I think I will exclude this one. So instead of using a margin of safety of 25, I would use just a margin of safety of 20. So obviously maybe for dividend growth, I think I'll exclude the dividend growth rate as well, actually, because normally I tend to want a higher growth rate, but for Verizon, it's not expected a higher growth rate. So I don't think we should punish them on that because that's not their opus morandi. So I think no matter what happens, I think they'll keep the steady course of using these 2%. So let's skip the payout ratio and the dividend growth rate. So minus 10, so bring it down to 15% margin of safety. Let's put that over here, which gets an acceptable buy price of $37, a bit below the current price of 41. So I think still it could potentially be an okay time. I think for the last couple of days, that's actually gone down a little bit. Again, if you zoom out to or zoom in, it actually went up again. So if you just had a few days here, 25, it went up, 24. So again, it topped around 42. Now it's back to the same. So you could potentially wait for a little bit of pullback before you jump into Verizon. I think it's a really good dividend growth, dividend income stock. You don't expect much growth. You know what you'll get. You'll get roughly equal inflation around these 2%, hopefully in the future, obviously. So I think Verizon, you can always probably buy into Verizon, but if you want a bit more of the capital appreciation as well, I think you could wait a little bit for a dip, or you could start a position now and then you could average down if it starts to drop. I think Verizon is a pretty steady ship. You can always buy a little bit of it. It should not be the biggest post holding in your portfolio, but I think it'll have a pretty good spot in most people's portfolios due to that strong yield and the free cash flow. So the management from Verizon, I'm pretty sure they have all of their thoughts going into how they can do capital allocation, probably to manage the debt and still not cut the dividend. As we saw from SimplySafe Dividends, the dividend safe is still rated as safe, and I still believe that as well. So for me personally, and I do have stocks in Verizon, I have actually added a bit on down. It's actually around my initial starting entry point right now. So for me personally, I'm waiting a little bit for a pullback if I need to add more, but I'm a very happy holder of Verizon. Thank you so much for watching, and I'll be seeing you in the next video.